and let's just say it's $100 million building, you put $1 million in this property, you're a 1% undivided owner of this multifamily trust.
So, what is this DST?
Yeah. So DST, Delaware Statutory Trust. And this rolls right. This is a perfect segue. The 1031 exchange, right? You can amass wealth and real estate over time. You exchange. And then Delaware Statutory Trusts, and I'll define them, but essentially it's a real estate ownership structure that's conducive for 1031 exchanges, right? So you can, if you sell a property, Jacqueline, and you want to do a 1031 exchange, you can go out and buy your own property. Or if you like, you could invest in a DST or multiple DSTs and also satisfy the exchange that way. So I just wanted to lay the groundwork from that standpoint. Delaware Statutory Trusts, or DSTs, they were created in the 80s. It's a trust, right? Yeah, they weren't set up for 1031 purposes at that time, but it's a structure or a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners. So when you apply this trust and own real estate within, it creates a situation where you can have fractionalized ownership. So you think about like a GP or an LP structure, most of those are not set up for 1031 exchange purposes. You invest cash, after tax cash, do your thing. Well, the DST, this fractional type of ownership, is 1031 exchange eligible. So in 2004, the IRS came out and validated this fractional type of ownership as real property ownership and therefore eligible to satisfy 1031 exchanges. So what you have is, I refer to them as sponsors, right? Syndicators, sponsors, big real estate companies. I'm gonna throw out some big ones just so the audience, whether it be Ares or Jones Lang LaSalle or Apollo or Starwood or Cantor Fitzgerald. These are big real estate companies, and they're involved in the DST business among 50 others. But they go out, a sponsor will, and they'll buy we'll just use Cantor Fitzgerald. They go out and buy $100 million multifamily property in Dallas, Texas. It's stabilized, high occupancy, income producing. So they buy it, they turn around, and they offer ownership interests to everyday mom and pop retail investors like you and I, for the most part, right? Jacqueline, you're selling a property. In one situation, you're selling it, you can't find anything. And you're like, what do I do? I don't have the debt. I don't know what to buy. These DSTs are, again, turnkey. They're already owned. You can exchange into them quickly. And let's just say it's a $100 million building. You put $1 million in this property. You're a 1% undivided owner of this multifamily trust in Texas. You're entitled to 1% of the income, 1% of the expenses, depreciation, and appreciation upon sale. And Cantor Fitzgerald does everything. They're doing the asset management. They hire, more times than not, it's third-party property management. They're paying monthly distributions to you via ACH. They're sending out quarterly performance reports, end of year tax returns. So it is a turnkey 1031 exchange replacement property solution. And one last thing, then I'll take a pause, is going back to the up to 499 beneficial owners, because you're allowed so many investors, the minimums are low. I mean, 100, 250,000. Again, you sell a property for $1 million. You could, in theory, you could break up that equity and diversify into many different DSTs, right? You could put 250,000 in the multifamily in Dallas, Texas, 250,000 into a self-storage portfolio in Raleigh, North Carolina, 250,000 into a medical office campus in Orlando, Florida, so on and so forth. So you can diversify their income producing, satisfy your exchange. Yeah, so I'll stop. Did that make sense?
Wow. Okay, so I didn't know much about DSTs, but that seems like a better option if you are going from being a very active investor to running and operating, a large portfolio on your own. And then now you're like, yeah, I'm getting a little bit older. I wanna step back a little bit and I wanna be a little bit more passive. Seems like DST is the right way to go.
And you hit it right on the head, and I want to talk about the downside real quick, and then I want to hit on the prototypical investor. And that it's an interesting demographic story. But the downside to DSTs, and there's a lot more, we only have so much time on this, but the downside to DSTs is that they're illiquid, right? There's no formal secondary market out there. You could say, hey, I want to get out, or I need the cash. You can't. So you're in there for 5 to 7 years, most of them. Now, when they do sell, you do have the opportunity to do another exchange, either into another DST or into another property of your own. So it's not like the last stop. So that is really the biggest downside for some. For many of our clients, it's a blessing. They don't care. They don't want any control. The story I want to tell is, and I've been in this business, as I said, for 20 years. So I got in the business in 2006, 2 years after the DSTs were actually legitimized. years. So I've been in a long time. I've seen it evolve, and it's very neat to be able to reflect on the evolution. But here we are today. Baby boomers and seniors represent the majority of the wealth in our country. And a lot of that wealth is in private real estate that they have worked their tails off to accumulate, aggregate, manage, for 20 to 50 years. And here they are today. They do not one more phone call from a tenant. They don't want to fix one more toilet, right? What do they call it? The toilets, trash, termites, tenants. Yeah.
Tenants, toilets, and termites.
They are over it. They are over it. But what are they going to do? I could sell this property, but then I have to go out and find another property. What if I don't find the other property? I have to pay tax. And what is that going to do for me? It's still going to require me to buy something else, and I'm still going to have to be somewhat involved in management. What do? You combine that fact with these folks, and I'll tell you, 8 out of 10 investors, and we do, lots of exchanges. 8 out of 10 investors that we speak to today, they were content with their return when they bought the property, right? So 30 years ago, they bought, little Mrs. Smith bought a property for $1 million, just get 10% return, whatever, best thing in the world. Well, today that thing's worth $4 million, and she or he hasn't increased their rents, right? Because most folks are interested in keeping that tenant. They don't. It's a good tenant. I'm not raising the rent, and so most investors today are earning very little cash flow relative to the price, between 1% and 3%. And then these same folks have, if they've owned it for a long time, they're fully depreciated. So not only are they earning very little income relative to what they could be earning, but they're also paying 100% ordinary income tax on the little income that they're earning. I love what I do because I'm delivering a solution to what I consider to be a widespread problem that nobody really knows about what I do, and those that do don't really know it. So I could go in there and, more times than not, relieve them of their management responsibilities, defer their taxes, of course, increase their income significantly in some cases. We can add back depreciation through, non-recourse debt and refill that depreciation bucket and create the quality of life and freedom that they have been hoping and dreaming and praying for.
I love that. Yeah, I mean, I think the light bulb was going off in my head, right? The next step, like what happens when we sell our portfolio that we have here locally? What's the next step for us? Is it to buy a 200 unit somewhere and run and operate it? Or do we have enough cash flow from diversifying our investment portfolio where that's not a concern anymore? So I love that option. So let's talk about, and I'm sure this kind of moves into it. So you're talking about self-storage and mobile home parks and diversifying into DSTs or doing 1031 exchanges. So talk to me about alternative investing and why it's important in looking at your portfolio. I love this topic because so many people think about one or the other. They think about cash flow and they don't think about taxes, or they think about taxes and they don't think about cash flow. And I think it's probably 50-50 in what I see out there. And I'm like, no, guys, you got to think about both. So shed some light on that.
Absolutely. Again, our clients, the prototype baby boomers and seniors, older, in retirement or soon to be in retirement. And the DSTs, they fall within the broader alternative investment world. And so the story I will tell, it's not a story, it's the truth. But if you go back to 2008, right? 2008, the world was falling apart. Everybody that did, the folks that did everything right, they diversified their portfolios. They had liquidity, they had their stock and bond allocation all worked up, they had real estate, they kept their debt, modest. They got hammered. They got crushed. And like the traditional, as you were saying, the traditional portfolio model or advice that we've been fed for as long up until 2008 broke. It's like, what do you mean? I got hammered and I did everything right. And here we are, and I'll come right. Everybody, most of the retail population got crushed. Who did well, right? That's what you want to see. Who's doing well during that time? And it's the big boys, the institutions, the endowments. And you go, okay, well, why do they do well? And all those, the big players then and today have 30, 40, 50% allocation to alternative investments. So what are alternative investments? They are investments outside of your traditional basket, your stocks, bonds, annuities, mutual funds. Alternative investments are private real estate, debt, income producing investments that aren't tied to the stock market for the most part, and they tend to be defensive and income producing. So if the market's down, it doesn't mean that these private alternatives, whether they be, I'll just give you an examples like mineral rights, oil and gas mineral rights, or private debt funds, private real estate funds that are focused on manufactured housing or mobile home parks, right? When the world's going to hell in a handbasket, these defensive, resilient, necessity-based sectors may not be killing it like they were, but they're not going anywhere, right? They're going to be income producing. And so what happens if you incorporate alternative investment in the portfolio, historically speaking, it reduces overall portfolio volatility. It increases your income. It increases your tax efficiency and increases the overall value and stability of the portfolio long term. And I know I just said a lot. Hopefully that made sense to some extent, but that's the beautiful thing. And this, I'll stop right after this. Alternatives are becoming popular, more popular today as a result of 2008, but they're still widely unknown. Even from the wealth managers and the advisors, they don't know. And it's not their fault. They just don't know. That's what we do. And we evaluate funds and which ones are good and so on and so forth.
Yeah. So I recently seen something on Facebook the other day. The cat had a little like stacked graph to show how diversified these multimillionaires and billionaires are in their investment portfolio. And it was interesting to see how diversified they were, and it typically looked like if I made my money in real estate, that would probably be the biggest bucket. And then you'd probably see another 10 to 15%, 10 to 20% in some kind of like oil and gas, and then you'd see a small percentage in stocks and bonds. And that it would all differ, but it was very interesting to see that stacked graph as to the diversified portfolio and what made them what they were today, the multimillionaire and billionaires out there. So, and I think another thing is I'm thinking about our portfolio, I go, oh man, we're really diversified. We're in mobile home parks, syndications, triple net, all that stuff. And then we're in the affordable housing space in our local market. Are we really diversified? That's all under umbrella called real estate. Be careful when people say diversified. I think we're diversified when it comes to geographically from different asset classes in real estate, but in totality, when I look at it, it scares me a little bit. All of our portfolio isn't under the real estate asset umbrella. So I'd like to look at other alternative investments, oil and gas, gold and silver, some VC funds, right? To take a little bit of a gamble if you have that money in capital. So that's kind of where we are. So what kind of advice would you have to somebody in our bucket that has, their entire portfolio under the real estate umbrella?
Yeah, you hit it on the head. It's about diversification for sure. And the real estate folks like yourself, we don't like to stray far from real estate. That's what we know. It's what we're accustomed to. But you're absolutely right. You've got to diversify. Who knows, right? You don't know what you don't know. Folks, older folks, they've come back. The stocks are back. The bonds, are back. The real estate's back. You can't and then it's they're 15 years older now. They could not afford another 2008. And hopefully we don't see that. But to your point, you should be thinking about diversifying. You should be thinking about sheltering income, from taxes and building, and whether it be mineral rights or tied to commodities, right? You said silver, gold. Then we have, fast food restaurant chains. There's so many different investments out there. It's the key word is diversification.
Yeah. The one thing I would say is no on restaurants. So a little background about us is, we ran and operated a gelato shop where we lost over $1 million, and it was very difficult no matter what we did to try to make it didn't work, right? And some of that is out of our control. So I would stay out of the restaurant sector of that. And it's interesting when I go to some of these large conferences like Family Office Club that I attend on an annual basis, a lot of them will exclude restaurants. So I found that that's interesting when you have these millionaires and billionaires up on stage kind of talking about, hey, what do you invest in? Some people say, hey, a gamut of things. And then they always end it with, except restaurants. A few of them say, hey, I only invest in cannabis, or I only invest in real estate, or something of that nature. But I hear restaurants are, some of the hardest asset classes to make work. I'm a believer in that. That was a hard $1 million to lose, over 4 years, but it is what it is. We're in a better place. And hey, let's face it, those losses experiences make you better, and lesson learned, right? Because without that, we wouldn't be where we are today. So Ben, hey, this has been super great and amazing. If people want to talk about 1031s or DSTs or just alternative investing, because they may be in a situation where they want to get out of the traditional, stocks, bonds, and mutual fund rat race or investing cycle, how can they find you?
Sure, absolutely. So we could, well, first, so I have a business partner and we have 10 advisors on our team. So we're nationwide. Perchwealth.com, Perch wealth.com. I always throw out my cell phone number. I'll always get back to you, maybe a day or so, but 818-269-4972. That's my personal cell phone. Yeah, I mean, those are the best ways to contact. You can get me direct, go to our website, you'll see everybody there.
Awesome. Awesome. Well, thanks, Ben, for sharing so much knowledge with us today. I personally learned a lot, especially about those DSTs. So that's exciting for me. I could start having those conversations with my husband on things to think, as we continue to grow forward.
Yeah, you're still shaking and moving. You got a lot to do, and you don't need to do this. You're too young, but 20 years down the road, maybe you're
Yeah,
good.
20 years. Exactly.
Anyway, thank you so much for your time and the
Yeah,
opportunity.
my pleasure. And let's keep in touch, okay?
Will do. Thank you so much.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.